Good evening, everyone, and welcome back to the action plan. We're back again with Ram, our in-house stock market specialist, who's here to take us through another part about how to invest safely and to get good returns on the stock market. So, good evening, Ram. How are you doing?
Excellent, Glenn. Thank you. Welcome to the viewers in India and around the world.
Yes,
Doing good.
great. So, how is the stock market doing now?
Bit really volatile right now because of the budget and the monthly expiry coming in another 2 or 3 days. So we are really finding it really volatile. So to keep our cards tight to our chest, Glenn. That's all I can tell right now.
No, that's I think a good time to talk about when do we need to get out of the market rather than getting into the market. So I think our topic of the exit strategy, I think, is a good time to talk about it now, right? Because these are times in which people sometimes panic and start taking decisions when the market is not really stable, correct? So tell us about, first of all, why do you feel we should be talking about the exit out of a market? I mean, we always should be talking about getting into the stock market, right? So that is the
Right.
time where we need to pick the right stock, we need to pick the right time and to get into the market. So why are you saying that we should focus on the exit?
See, Glenn, before we go on to when to exit, basically when they're selecting a script, when you select that this company is good and I'm going to invest in this, it's basically purely economics which we are seeing in this. It's purely demand and supply. When there's a demand for the stock, then you have to enter. That's a buy signal. It says there's real demand, the stock prices are going up every day. So you just jump into the bandwagon and you also get some scripts of some shares in that script and you keep it in your demat account. But when the supply side becomes more, when the sellers become more, that is a time when the market starts. That's one that particular script starts to fall. So then you'll have to realize that, okay, right now it is going to be a slope where I'll have to exit and I'll have to get out. So basically, Gren, when we talk about entry and exit strategies, again, we'll come back to the old point when you're a passive investor, it doesn't matter much because you're going to select a stock, you're going to invest in that script, and you're just going to leave it for, say, 5 years or 6 years or 10 years down the line. So it's like a real estate. Real estate, when you buy a land and after 10 years, you see it's 100% it's going to appreciate. The same way, that particular script, when long term, is definitely going to appreciate. When you're talking about an active investor, definitely he does not use the expertise of a trader. So he has to look into this. He's the person who has to really look into when he's going to enter and when he's going to exit. Because, Grin, like when you half the times what I've seen is when you enter, the script is already 50% up. Because always we have tell this when we do our stock market analysis. There is nobody who can time the market perfectly. Let us understand this. Even Mr. Warren Buffett himself has told there is nobody who can time the market. He's been one of the messiahs of this particular industry, and he himself accepts timing of the market is not possible by anybody. But what we can do is we can tend to jump in at the right time and not exact on all scripts. Maybe 8 out of 10 times you can do it right when you analyze those charts and everything. So when you talk about entry and exit strategies, you'll have to purely go on the technical side. And technicals, I tell you, is a pain to understand. You'll have to really undergo a stock market course for 6 months or 1 year. You'll have to understand the chartings, and there are a lot of other charting techniques also. The bar chart, the line chart, the candlestick, and the candlesticks are the most used charts today. And it's a Japanese technique which was found in 1700. A lot of people use the candlesticks to identify when to enter and when not to enter. So these are certain things of the general concepts. The demand and the supply mainly make up uh, the time of entry and exit for a particular customer. But coming back to this, I would not like to go into the technicals because it is tough to understand technicals in just 5 minutes or half an hour. That is not going to work out. But if people are really interested, I can just show you one or two screens in the next couple of lives where we can really understand what graph means and what it tells us. But basically today I would just like to touch on the fundamentals. Like if you're entering a script, what you're supposed to see, and when you're exiting also, the same five risks, the risks which I call it, will always be there for you. So you'll always keep in mind these five risks when you invest in the stock market. So the first risk when I talk about is always a commodity risk. The commodity, because Gren, let us understand when you take an agri product, basically say cotton. This cotton is then taken to the spinning mills, then it's converted to yarn, and then that yarn is taken to either a weaving factory or a knitting factory and converted to a t-shirt or a shirt, and then it comes out. So the commodity, the raw cotton which we saw, changes hands many a times. So the farmer who sells the cotton is going to add his margin. The spinning mill is going to add his margin. So when the commodity changes hands every time, the price goes on increasing. So what I mean to tell here is, as a commodity risk, like when the cotton crashes down, for example, there's huge amount of cotton in the market. Then all the spinning mills which were holding the cotton stock for converting this yarn are going to face the music. They cannot go and buy at a cheaper price. So the commodity prices are high. They're going to maintain certain inventory levels where they're going to talk about the raw material. Another classic example we can talk about is the oil and gas. When the exploring companies like Kane Energy and everybody explore, they have a certain cost. And when you sell it to the refineries to refine the crude oil to petrol, diesel, and gasoline, then it, again there's a cost involved. And from these people, the oil marketing companies take it and market. So it changes three hands where the profit margins go on adding. So like when, for example, now when Reliance comes out with a total model from exploration to selling, it will definitely be cheaper than this model what we are talking about, because the middlemen are cut out, or the different sectors are cut out. So these are certain commodity risks which we'll have to really look into, basically, because a commodity risk is huge, because we are all dependent on agri products or something which is primarily of huge volatility, which
So,
changes from yes, go ahead.
so I'm just to understand. So what you mean is that if you are investing, for example, into a cloth industry or textile industry, right, or textile script, you should be looking at how is the raw materials performing as well, right?
Perfect,
Not just the textile script, because the textile script by itself means nothing. So they
correct,
are in turn dependent on the raw materials and how they are operating in the market. Is that what you mean?
correct, true,
Okay,
because
got it.
see, like Gren, if you ask where do we get all this information, one, every day morning when you open the newspaper and the business columns, every paper has a business columns, you have all this there, like 90%. When there's a huge fluctuation in prices, that is almost captured there. Even in the rice, because the rice, for example, when you take rice, the pesticide is a huge component of that. So when the pesticide prices increase, see, that's what I'm telling you, Glenn. When we talk about a product, it's dependent on many other products, ancillary products. It's not directly involved only with one product where I just go sow the seed and take the harvest and come out. It's not going to happen. There's a lot of other costs involved. So basically, I've got to just, I'm not telling, don't go deep inside. Just have a knowledge about this, where we are really heading to, because you're investing your hard earned money into this particular sector. So just know where the sector is heading. So I would advise you not to invest in all these sectors where put your eggs into all the baskets. Select 5 or 6 baskets where you will be able to actually scrutinize this on a periodical basis, and just invest in those 5 or 6 baskets. That's enough. Basically, that's it.
So Ram, so one is the commodity risk, right? So what's the second one?
The second is this has like actually what we call it is, it has no influence on this, but has a huge impact on us. We call
Okay.
it the headline risk. See, the headline risk, what we call the classic example I can give you is the 2007 subprime crisis in the US. See, when the Lehman Brothers and the other fellows really crashed, the whole market went for a toss.
Mm.
See, somebody in US and the subprime market there, the housing market there crashes. I have absolutely no involvement in that, or I have no impact on that.
Mm.
But if you see, the share markets crashed in 2008 in India because
Correct.
of subprime crisis.
Mm.
These headline crises are a huge impact. For example, another thing which we can say is today what happened. Today, like there was small news at 11:15, which told in Sikkim area, India and China had a dispute. And the two armies had an impact, and 20 soldiers were injured on the Chinese side, and 4 soldiers were injured on the Indian side.
Mm.
So this is one market news which comes out. And immediately the market tends to react to this news.
Mm. Mm.
See, like there are some sectors which may not be even dependent on that, but India as a whole, they think is almost on the verge of a war with China. So it immediately strikes on the share market, and all the sectors across the line goes down. They don't care. So the headline risk is a huge risk, which we'll have to always keep looking out. And as we say, again, I told you the newspapers will give you this. They would automatically capture all these news and give it to you. And they would put it out. For example, these farmers rally, which is happening tomorrow on the 26th of the Republic, the tractor rally. So the agricultural ministry is seriously having a keen watch on this, and it has a huge impact on this. So
So you
something like
mean
this.
that? Yeah. Sorry, I cut you off. Please go ahead.
No, tell me.
No, so basically you're saying that whatever the headlines says is sort of like an influencer on the way the stock performs, right? It
Correct.
doesn't directly affect the stock in any way, but it's more about the perception that the people who buy and sell stock take from the news that is being projected, correct?
Correct. For example, when the Capitol Hill in US was invaded by the public last on
Mm.
15 days back, that had an impact. And when Joe Biden was supposed to take over, the markets responded positively. They thought it's going to be a good moment for the markets because Biden is going to take over and he's going to give a good stimulus package and everything.
Mm.
So this has in no way it is connected with India, but the Indian markets tend to react to all these news,
Mm.
which happened in the US. Not only in the US, when the UK variant of the coronavirus came, again our markets crashed for that particular one day. We had it was on December 22nd. I still remember because I had a huge impact on that day for my customers. So I cannot forget that particular day. It just crashed like hell. It just went 2-3% down. So
You're
something
saying
like
the
this,
headlines. Yeah, I'm sorry, I'm talking over there's a lag. So basically the headlines are a second factor. So what is the third one?
the third is of course, Gren, the rating risk. See, every company has a rating. When we talk about this rating, a lot of agencies give ratings. CRISIL is one. CRISIL is one real good company which gives a rating. CRISIL rating is really has a huge impact. So when CRISIL or Moody's downgrades a company, what happens is the financial institutions which are funding the companies tend to increase their interest percentage. They don't give it to you a cheap cost.
Mm.
The borrowing cost is going to increase. So the classic example again I can give you, and this is Bharati Airtel. In August, there's one thing called MSCI, sorry. It's called Morgan Stanley Capital International. These fellows told the weightage given to Bharati Airtel is more. We are going to reduce the weightage. Immediately, Bharati Airtel, which was trading at 570, comes down to 380. In just a matter of 3 days, we lose 190 rupees straight away in the market. A fellow who's invested in Bharati Airtel at 570 sees it at 380. He really tends to panic. Now, what next? Let us understand, viewers, your script, which you are doing a fundamental analysis. You know what it is worth it. You are strong and your conviction levels are there. Don't go by the noise. Now, what happened? In August, MSCA tells us this. Now, SEBI and other institutions tell MSCA, no, Bharati Airtel is having this kind of a weightage. Now, it's again revising. So, from 380, Bharati Airtel has come back to 590. It was a matter of 5 months. I do accept. You have to wait. But let us be clear that the share which was at 570 went down to 380 and has come back to 590. Just because of one rating, this fellow told, no, it doesn't have that weightage. I'm reducing the weightage. Finish. There goes the whole thing, the story. So The rating agencies play a vital role in the company's day-to-day affairs. These fellows come and say this company is performing bad. Who's going to lend you money? Nobody's going to lend you money. So for further expansion, further growth, everything is curtailed. So this is the third risk we're talking about, Grenville, the rating risk.
Rating risk.
Now, yeah. Now coming to the fourth one, I will call it the adaptability risk. See, like we all know a company called Nokia. It was one of the market leaders. And all these fellows, whenever we wanted to buy a mobile phone, the first choice was Nokia. Only then we used to go to Samsung and Motorola and other companies in 2005, 6 and all. But what happened later? See, Nokia didn't adapt to the changing environment. They told this is my company's model and this is what I would work with.
Correct.
But that model died out. Another classic example I can give you is Kodak. These fellows were the leading fellows in camera manufacture. Today, Kodak is nowhere because the model died. They didn't adapt to the digital world. And another classic example who really did that was Reliance. See, Reliance was into petro products, but Mr. Mukesh Ambani sensed the future is mobile. And in 2000 itself, started Reliance Communications. But of course, then it was, they had a family partition and everything. And finally, he came back with Jio again because he knew the future is only going to be mobile services. And today he's rocking. So he is adapting his company to the latest technologies. And he's already ready with the 5G. We guys are normally buying 4G phones. He's ready with the 5G technology. So when we roll out, he's telling, I have the equipment. So that's the kind of adaptability you'll have to have. We can call it adaptability or model or whatever risk you want. So the risk, the adaptability risk, you have to adapt to the present conditions. You don't adapt, you're going to fail.
Yeah, so but I have a question, Ram. I'm sorry, I'm talking over you. No, I just have a question. See, when you talk about adaptability risk, this is more, isn't this more a long-term impact than a short-term impact? I mean, if you're looking to be a regular investor, you would be there for maybe a few weeks or a few months, right? On an average, I mean, when you're investing in actively in the market. So adaptability risk would be that unless you're at the end of the cycle, where they really are, is where that you may have an impact on a short-term basis, isn't it? Am I right, or am I missing something?
See, Gren, when we talk about this adaptability of model risk, as you say, 100%, as you rightly put it, it comes at the end of the cycle. But for a passive investor, see, a fellow who puts in the money and forgets this, he says after 7 years or 10 years, I'm going to take the stock and see. He's going to have a huge risk. He has to review his portfolio every 1 year or 2 years to see where these particular scripts are and how they've performed. At least for the sake, because he's invested his hard-earned money into this. And for an active investor also, Gren, see, he might enter the market at the cycle end for his bad luck. He has to keep in mind, because see, that's always we tell. We like active investor, because the market always sends us the news much higher, Gren, much before. See, for example, the telecom is the talk of the stock markets today. All the telecom sector like Vodafone or Bharati Airtel or Jio are performing very good because the spectrum auction is happening now. So, but what happens is these market feelers have come out long back. In December itself, the telecom script started picking up. But as an active investor, what you would see is normally you would see when Vodafone from 9 rupees has come up to 13 rupees, you will jump in at 13 rupees, thinking that 15 rupees is the target. But this script has started going up from 9 rupees. So a trader who sits in front of the laptop or the desktop or his mobile for 6.5 hours every day would have caught this moment when it was 9 rupees itself. Because his charting techniques, everything would have clearly indicated him, boss, this is going to go up, please invest here. So when you don't have that kind of cushion or what do you call
visibility
fall on, you really have to depend only on the fundamentals. You have to really look into this. So like you have to see where you are investing when you're investing. and when you're going to get out. Because like at 15 or 16, when you really make good profits, what my advice would be is walk out. See, people are thinking that it's going to go to 20 and wait. It's not going to go to 20 immediately. For an active investor, you book your profits, come out. See, if you want to go really deep inside, I can give you two datas which you have to just daily on a daily basis see. One is the price and the next is the volume. At what price and what was the volume which traded. These are the two factors which really decide on a technical basis itself when do we get in and when do we get out.
Right.
Because the candlesticks with the volume will really tell you when we really enter and when we really exit. But when you don't have that kind of an opportunity to see every day and every hour and every minute, you have to go by the fundamentals. I would tell you, go by this. These are the risks you still have to just take care. You would decently make money and come out. You wouldn't make extraordinary money, but you would decently make money.
I think
And
you really. Oh, sorry. Please. Go
yeah,
on.
go ahead.
No, I think the way you summarize these 5 points make a lot of relevance. I mean, they're very simple guidelines that you should normally look at as when you do an investment, right? But very deep, as you said, it's not that simple to just walk in and go and understand what is the model of the business that you're getting into and where are they in their life cycle, right? It's a much more deeper and a much more what do you call in-depth analysis that is needed to be able to understand that. So
Correct.
yes, your guidelines are
The
very
next
simple
one,
to think about. Yeah, please.
the next one is Grenville, detection risk. See,
Mm,
detection risk again, the classic example we guys have in front of us is Satyam.
mm,
Satyam was a company which really took everybody by storm and it really went up, only to see it crash down,
mm,
taken over by the Mahindra Group, and now it's again rebuilding up and it's again coming back to its old glory days.
mm.
Another classic example, like in the last 3 months, was a script called, I don't know how many people follow this, but I follow it every day because one of my favorite scripts, UPL. It's
Mm,
called United Phosphate Limited. This
mm,
particular company, one of the whistleblowers told these fellows are siphoning funds.
okay.
Immediately, see the script is trades at 500 rupees, comes down to 390 rupees. Gone. Again, then the next day, the managing director of the company, Mr. Shah, comes in and says, no, this is the wrong news. This is what we are, and this is what the auditors have certified. And from 390, see, from 500 to 390 it comes down in 2 days. But from 390 to today, the UPL shares are trading at 590. It's
Mm.
gone back. But it took almost 1.5, 2 months for it to rebuild back to its old cost.
Levels. Mm,
Yeah. So see, like the fall will be very rapid, but the growth will be very slow. So when you have these kind of news is kicking in, because we call all these as sounds, unnecessary sounds made around the companies. You do your homework. You know what the companies are. You have studied the balance sheet. Have your conviction. Again and again, I'm telling you, viewers, have your conviction levels to yourself. Don't get carried away by the noise. See, for example, UPL at 500 to 380 and you sell it at 380 and book a loss. You're going to repent because at 380 again, it's gone back to 590. It's gone back 210 rupees. So hold your stock. You're going to hold it for a longer time. Being an active investor, say 15 days is going to become 1 month, but it's worth the risk you're taking. Hold the cards tight to your chest. Just sit tight. You would make your money. Don't lose it. And the last one is, of course, the government policies. See, today we are facing a huge crisis again. The best example I can give you, because we're coming to the end, I'm just rushing through it. The crude prices have gone up heavily.
mm,
So what the opposition parties have started talking is the excise duty is very high. So what the government might do in the next few days is cut down the excise duty to bring down the cost of petrol and diesel. So what happens is this has a direct impact on the oil marketing company's income. So what happens is the OMCs are going to take a beating.
okay.
See, this is one sound which is being made now. Already it's started making sounds from the last week itself when the crude
Okay.
prices started shooting up. So what happens is the government, so now the government is also told, yes, the crude prices are up, we will think about revising the excise duty. So
Mm,
automatically what happens? There are some jittery in the oil marketing companies' script prices. They tend to react immediately.
Mm.
So these are certain risks which we have to see. Just to summarize it, because we're almost at the end. One is the commodity risk, then the headline risk, the rating risk, the model or the adaptability risk, and then we call the detection risk, and finally the government policies. The six you take care, you would be safe in your investment. I'm sure you will not lose much. See, you select 10 scripts, you will make money in 8. You might lose out on 2 because the noise will be so big that you have to exit. You can't just ignore the noises then.
So no, but Ram, I think you said it pretty well, and I think it's very, very apt that we've ended it like this. I think sometimes the advice that you get sounds very simple and sounds very easy, but I think the important part is the in-depth information you need to gather and how you're going to really use this to your own benefit. So I think that is very important on how people take this and how do they actually use it. That is the more important thing. So thanks, Ram, for your time again. Thanks for sharing this in-depth information, and I'm sure that a lot of people have gained a lot of benefit from what information you shared. So for everyone, thanks for those who came on live, and thanks for those who are going to watch the recording of this video. We do this FP Lives every week at 9 p.m. on every Monday. So please join us next week for another video. Till then, take care and be well.
And thank you, viewers, from my side. If anybody wants to invest only 1 lakh or 2 lakhs, I am there. I can do it for you. I do my portfolio management services for a lot of people with just 1 lakh and 2 lakhs. You can contact me. And from next week, what I thought is more on I thought I would do a sector analysis for you, taking up every sector, because that is one crucial point where how the sectors are performing and how to analyze a sector. So we would see how to go about sector analysis. So because these are all fundamental analysis we talk about. So I would talk in brief about that in the next few sessions. And if you really feel that some topic has to be covered, I will be really happy if you can comment it on the comment section, such that we can take it up and we can answer that as well for you, and we can have it covered. And again, I'm telling you, viewers, anybody who wants to invest a hard-earned money of 1 lakh or 2 lakhs, only a small kitty, and see a good return with a minimum amount of risk, I can do it for you. I am there for you. You can contact us. I will be really happy to do it for you. And signing off for this week, thank you and good night and goodbye and stay safe. Thank you. And a happy Republic Day, Vande Mataram.